All right, well, Wall Street digesting the latest jobs report, which shows that the labor market is slowing. Unemployment jumping in August, unemployment rate, I should say, jumping in August, up 0.3% to 3.8%. It's the highest level that we've seen since February. Wage gains also moderating, a sign inflationary pressures are easing. Hiring remains steady with 187,000 jobs added. Traders and are betting that the Fed is more likely to hold rates steady. Markets pricing in a 93% chance that the Fed will pause at its meeting later this month. For more on the labor market and what it means for the economy, we want to bring in Nela Richardson, ADP Chief Economist. Nela, it's good to see you here. So certainly it looks like, at least when you take a look at that unemployment number, rising 0.3%, 3.8%, the labor market is slowing. Is it slowing enough, though, for the Fed?
I think that rate is really interesting to watch because it could be slowing, but for the right reasons for the Fed, which is more people are coming into the labor market. We've gone from 3.5%, which is a historically rock bottom rate, to a slightly higher 3.8%, but still below 4% on the basis of more people joining the workforce. So good news in terms of labor force participation that also went up. And that is a great number to watch in terms of a Fed who's worried about tight labor markets. There's a sense that those markets are loosening, which means not quite as strong wage growth, which will not likely be more at risk of driving inflation. So from the Fed's perspective, I think this is along the road of what they would like to see.
Yeah, labor force participation up for the first time since March of this year. We're looking specifically at increases from older workers as well as prime working age women. What's driving that?
You know, that was a trend that was going on before the pandemic. Women's workforce participation was high, and there was this ongoing trend of people 65 and older staying in the workforce longer. And that's really, really important when you have an aging population that is growing faster than your workforce population. That growth in of itself is inflationary. So the fact that this trend is getting back to normal or getting back to pre-pandemic levels with women participating in the workforce after being harder hit by the pandemic and older workers rejoining the workforce is good news for a lot of reasons.
Nela, what does all this mean for a recession or lack thereof? Because most of the base case here going into this report was the fact that we would be able to navigate the soft landing. Is that still intact?
I think it is. I mean, the transition period from going from super strong growth to slower, more typical growth can be jarring. And you can't fall asleep on these numbers. The move from 3.5 to 3.8, it's still a very low unemployment rate, but it's a pretty sharp increase in 1 month. And so it's really a number to watch as we go into the fall. If that number is going to continue to climb, that's going to tell us a lot of what we need to know in terms of whether we can achieve a soft or hard landing. But if you match this labor market data with very resilient indicators coming from the consumer side, it doesn't look like we're heading into a recession anytime soon.
How do you think we should be looking at the lag effects? I mean, we've been talking so much about the lag effects of monetary policy, the fact that we have really just started to see some of that take hold. Is the economy strong enough to withstand some of that?
You know, as strong as this labor market is, it's highly fragmented. And you've seen those effects already take hold in manufacturing, which is an interest rate sensitive sector. There was barely any gains in manufacturing this month. And at ADP, we've been tracking manufacturing and we've seen some weakness all year. So though this is a solid job market, it's also a highly fragmented one. I think you're seeing the effects of Fed policy, but only in pockets where whether it hits overall, it will depend on where that terminal rate ends and how long the Fed keeps rates at higher levels. Right now, because of all the stimulus that was part of the pandemic recovery, it's taking longer. So the Fed policy is even more lagged than normal.
Nela, where do you see that terminal rate ending?
You know, that's a great question. I think the Fed's job is harder now than it was when inflation was higher. Ironically, when inflation was at 9 and 8%, there was really only one direction to go, which was to hike rates. Now that we're getting inflation that is much lower, but still about double the rate on core that the Fed would like to see, their decision point is much trickier now. It wouldn't be surprising to me if there was one more rate hike. It wouldn't be surprising to me also if they paused, but a pause shouldn't mean a stop. Or doesn't necessarily imply a stop. They could pause just for a month like they did back in June and then decide to raise rates again. So I think it's very tricky for the Fed over the next few months.
Nela, it's been a very busy summer in terms of activity coming through from labor unions. And in this jobs report, we saw the actor strike subtracted roughly 17,000 jobs from payrolls in the industry. You've got another potential strike on the horizon, looking at UAW negotiations, that September 14th deadline. How big of a risk does a worker stoppage in that industry present when you think about the overall picture we're looking at right now?
You know, strikes are bad for inflation. What you want to see is that you have a productive workforce, and strikes are a disruption in that productivity. What you hope is that at the end of this collective bargaining process, there is an agreement that works for both parties involved so that they can continue into the business of writing scripts and building cars, because ultimately that's good for the economy. But overall, I think it's another point of that fragmentation I pointed to earlier, this time from a different source, but very important to keep track of.
We will be closely watching that. All right, Nela Richardson, ADP Chief Economist. Thanks.
Thanks. Have a great weekend.